Chris, I'm keen to hear, where are you seeing value at the moment in the current market?
Sure. Look, so we see value in the same places, and I'm sure a lot of your clients that you're recommending similar things on the share side of things. So look, we've always been blue chip. We're very much about buying quality, buying the right thing. And I always say it's like, if you go and buy a jumper or a jacket from Myers or David Jones, you know exactly what you're getting. Sure, you're paying a reasonable price for it, but if something goes wrong, you get your money back. The same for property is buying stuff in, say, the eastern suburbs, the Lower North Shore, the inner west of Sydney. Sure, it's going to cost you a pretty penny, and it's going to be $1.5 million for a 1 or 2 bedder, but you're paying for that quality. Now, you don't want to be paying a premium. You don't want to be going to auction and paying 10 or 20% above that. But if you can buy it on valuation price, which is a very conservative price, whether there's a boom or a bust in those areas, there is no more property in Bondi or in Balmain or in Manly. They can't physically create any more because all the neighbours are butt up next to each other. So that's where we see the value. And sure, it's not half price, but effectively it's 10 or 15, maybe even 20% off by buying at those valuation prices. And this is why we sleep well in GFCs and COVIDs and whatever banking commissions, because the banks love that stuff as well. And so where some people have gone to regional towns and they've gone to the Barons and maybe they have doubled their money in the last 12 months, there is a danger that not everyone wants to live there for the rest of their lives. And then suddenly those markets will come off, whereas it's less likely for those inner city markets to come off as well. And so that's why we just see value. But in our experience, we find most people want that bargain, and they really want to make their million overnight. They'll do nothing for 10 years, but then they want to make that million overnight. Whereas we see, well, if you bought it 10 years ago and you made 100 grand a year, you've made your $1 million anyway, but without the volatility.
Yeah, I'm keen to unpack that regional trend because it's something that we're seeing a lot of with people moving as they see Sydney prices rising and then prices lower in relative terms in other markets. But interested in your take on, I, like you, sort of take the same approach when it comes to guiding our clients in property. Obviously, you guys are the experts in choosing the specific properties, but when we talk to people about their property strategy, one of the things that we say is that for us, we never, obviously you don't have a crystal ball, so you don't know what markets are going to go up, but really confident whether you do buy in some of those suburbs that you mentioned, you know, Surrey Hills, the inner west, Bondi, Lower North Shore, like one of them will perform the best, but they're all going to perform broadly in line, and they're all going to perform well over time. But we see a lot of people that it's normally like the engineers or the more analytical people that are crunching these numbers and trying to figure out, you know, looking at rental yields and historical growth rates and these sorts of things, trying to somehow sort of divine which is going to be the absolute best amongst those suburbs. What would your tip be for somebody that might be struggling with that sort of decision-making process?
I'd say don't. It's not worth it. So I've done Sky News, or I've hosted Sky News for over 10 years. The genius that I always knew and really looked up to was a guy called John Edwards from a company called Residex, which is now owned by CoreLogic, which is the biggest kind of data company for property investors. But there's also companies like SQM Research and Domain as well. These guys just analyze all of this information, and they're the ones that help the banks come up with their predictions for the future years. And as we all know, it's very, very hard to get it right. And most of them admit that, look, they can't predict the future. It really is tough. And it's all in the analysis of that data. So say, for instance, people might look at a vacancy rate, which is a good thing to look at. So, and we'll use Bondi, not because Bondi is the best, but just everyone knows it. It's an easy thing. So you might go to Bondi and say, right, the vacancy rate's 3% or 5% or 10%, and you read something into that. But also you could look at the auction clearance rates and things like that. But what we know after investing there for 20 odd years is if you've got a 2-bedder with parking in a small block that's walk up with a cheap strata that's got parking and a balcony and within a K of the beach, we know that gets rented, if it's in the right condition with the right agent, 100% of the time, or give or take 99% of the time. We know that could sell within a week or two. Whereas if you get something on, say, Bondi Road, that's in a massive block on a major road that's super noisy with buses and hoons, and it's got no parking, it's got no aspect, and there's no outdoor living, in a good market, that will always sell and that will always rent. But as soon as the market turns, that could have 100% vacancy effectively. And it could take months and months to try and sell it. And so this is the thing is, if you buy the right things, I don't care about the vacancy rate, because I know as long as it's in the right condition at the right price, it'll get rented out. And that's why you've got to read beyond these statistics, and the statistics can't tell you that stuff.
Yeah, it's interesting that I think that just to hear you say it like that, and it's something that we're broadly aware of, but I think a lot of people, yeah, can get too caught up on the suburb itself and maybe not think of the dynamics of the actual asset or the investment.